Hello, Duncan. Yes, it is my Dunkin' Donuts coffee, and this is my first. And I seem a little bit wound up. It is Monday morning, and today is April 25th, 2022, and I am Kenny Polcari, your host of the party. And here's what you need to know today, because lots went on over the weekend, right? On Friday, markets went into reverse. The Dow losing more than 3%, 981 points, and it is lower again this morning. Investors are raising cash from everywhere. Right? Investors, traders, and algos suddenly realizing that valuations are too rich based on where we're going. And while earnings are beating on the bottom line, declining revenues, declining top line numbers are suggesting weakness ahead. Treasury yields fall this morning as money looks for shelter back in the bond market. And what are we having for dinner tonight, right? So we're having the pulled pork. Oh my God, so good. But listen, the Dow plunges 980 points, or 2.8%, nearly 3%. The S&P fell 120, 2.7%. The Nasdaq lost 335 points, 2.5%. The Russell lost 50 points, or 2.5%. And the transports gave back 345 points, or just over 2%. The VIX, which is the fear index, shot higher by 25% on Friday to end the day at 2820, all while investors suddenly grew concerned about nothing new, right? It's all stuff that we know. And this morning doesn't look any calmer. Global markets are under assault. China declines by 5% overnight on concerns that the virus that has been spreading around the country is now spreading undetected in Beijing, sending that city into potential lockdown mode, putting even more pressure on the global supply chain as China has been unable to halt this strain. Hong Kong fell 3.7%, Japan was down 2%, Taiwan down 2.5%, and South Korea down 2%. So I have to ask you, what changed on Friday that sent the algos into panic mode? What new information did we get? And don't tell me it's because Jay Powell reiterated the 50 basis point move next week, because that's ridiculous. We've been talking about that 50 basis point move for weeks now, if not months. Investors and markets were fully prepared for that move. They, the Fed, making sure to tell us that it's okay, that the economy can handle it, that there's nothing to worry about. So please don't tell me that was the reason that the markets went into reverse. It was not. Markets, which have been struggling all year now, have gotten decidedly more bearish as we move through earnings season. And while 75% of the companies that have reported have beaten the estimates on the bottom line, many are struggling to beat the estimates on the top line. And now we're seeing weakness in retail and healthcare as well. So when you have everything that we've been talking about for months now, greater inflation, rising rates, weakening macro data, swift reduction of the balance sheet, the ongoing war in Ukraine, and the renewed lockdowns across China, joined by weakening or downbeat earnings reports from banks, retail, and now healthcare, what did you think was going to happen? Right? I mean, it makes perfect sense. So let's talk about it. On Friday, Gap stores, right, GPS fell 18% after they cut guidance that sent shivers through the industry. Names like Target down 2.5%, Ross Stores down 3.5%, Dollar Gen down 2.5%, Abercrombie & Fitch down 5%, Nordstrom's down 5%, Macy's down 6%. And the retail ETF, the XRT, fell another 4%, taking that ETF down 19% year to date. HCA in the healthcare industry, right? They announced on Friday at 7:30, and the algos were not happy with what they heard. The stock sank 11% in the pre-market and continued to fall another 11% during the regular trading session to lose $58 a share, or 22% of its value in 6 hours. Now, to put this in perspective, the stock had been up 7% going into Friday morning. Healthcare was seen as a defensive play, and so over the past 4 months, money moved into that name as it moved out of other names. And that made sense, right? But then on Friday morning, they reported a miss on both the top and bottom lines, and that sent the algos into a tailspin, sending the stock spiraling out of control, opening below all three trend lines and ending the day on the low. Other healthcare names that got slammed include Tenet Healthcare down 15%, Community Health down 17%, Universal Health down 14%, United Health down 3%, Anthem down 4%, and Cigna down 4%. Now, while this might be described as dramatic, the truth is that the markets have not been paying attention to what is happening in the economy and in the world. Many of the talking heads trying to maintain a sense of, well, it's not as bad as the economic data suggests, when the truth is, it just might be. I mean, why else are we getting this sudden spin out of control? The recent, very hawkish commentary out of every single Fed official has pointed to the need to be more aggressive than originally thought. I just wish that they had been this keen on the data 1 year ago when it started to suggest the building inflationary pressures, when they all remained at ease in the face of the worsening macro data saying, don't worry about it. It's all good. Nothing to worry about. We got this. Well, in addition to some of the earnings reports, Friday's data also reported a weakening of the services sector of the U.S. economy, right? Now remember, we're a 75% service economy, so this is important. On Friday morning, the S&P Global U.S. Services PMI, Purchasing Managers Index, came in at 54.7 versus the expected 58. Remember that 50 is the dividing line. Anything below 50 is contractionary, while anything north of 50 is expansionary. So yes, 54.7 is expansionary. But compared to last month's 58 report and this month's expectation of 58, 54.7 is worrisome. And it only falls in line with what the other data is now suggesting, and add in the weakening top-line revenue numbers that we're getting this earnings season, and now you begin to see what's happening, right? Fed fund futures are now forecasting a 75 basis point rate rise in both June and July, right? And they call for Fed funds to be at 3.5% by year end, a full percentage point more than what we were being told for months. And that is just a recipe for, well, we better take another look at this, right? Valuations, which need to be revisited as the data inputs change, got revisited on Friday. Revenue slows, guidance becomes more cautious, and the hawkish rate talk becomes more of the norm, then expect markets to adjust. Toss in the panic of the ongoing failed China zero-tolerance COVID policies that are further disrupting the supply chain, and the war in Ukraine that is decimating an independent country, causing ripple effects around the world that threaten energy supplies and food supplies, and you wonder now why markets are anxious? Now look, none of this calls for you to jump ship, but it does call for you to protect your capital and have some downside protection. So how can you do that? Well, you consider the ETFs, right? The SH ETF, which is the S&P short, is up 9.5% year to date. The PSQ ETF, which is the NASDAQ short, is up 18% year to date. The DOG ETF, the Dow short, is up 5.6% year to date. And if you choose to really lever up, the SPXS, which is the direction 3 times levered S&P short ETF, has been going higher. It was up 8% on Friday and is now up 26% year to date. But here's a warning. The SPXS is not for everyone. It's a volatile stock and it can cut both ways very quickly. So talk to your advisor before doing anything that is levered in a long-term investment account. U.S. futures this morning are down, right? As markets brace for a very busy earnings week. 160 names are set to report that span across the sectors. And now we're learning Beijing is at the risk of a lockdown due to surging COVID infections, threatening to shut that city down as well. At 5 o'clock this morning, Dow futures were lower by 300. The S&Ps were down 40. The NASDAQ down 100. The Russell was off by 25. The recent weakness causing even more damage to an already wounded market, and even the defensive plays are now under pressure as this reality sets in. Eco data today includes both the Chicago and the Dallas Fed surveys. Tomorrow brings us durable goods, capital goods ordered and shipped, and the Conference Board Consumer Confidence reading. New home sales are also due on Tuesday, and with mortgage rates now piercing 5% and going higher, this will be another key data point. Friday brings us the Fed's favorite inflationary gauge, the core PCE deflator, the Personal Consumer Expenditures Report. Estimates called for that number to be 5.3%, but after last week's very strong PPI report, it's going to be hard to see how this isn't worse than expected. So just hang on there, right? We got to wait and see what that looks like. 10-year treasuries this morning are yielding 2.8%, actually down 8 basis points as the move into treasuries is the ultimate safety trade. And that sends prices up and yields go down. Oil is trading at $97.5 a barrel after the latest China report suggests that a lockdown in Beijing is going to cause demand for energy to plunge. And it will if they shut the country down again. And that's what the market is telling you, that you're going to get more news out of China. We've now broken support in the oil market at 99.20, and it looks like a test of the low 90s might be in order. Lots going to depend on the chatter. Expect oil stocks to come under pressure on the back of this. ExxonMobil, Chevron, Occidental, already quoted down 3% in the pre-market. But remember, these names are up better than 40% year to date. European markets are also joining in, all falling more than 2% across the board. French voters have put Emmanuel Macron back in power, defeating nationalist Marine Le Pen. Now we're going to wait until June to see what happens at the legislative elections, right? Will Manny maintain a mandate or not? What will that do to the balance of power in France if he loses the mandate? Word has it, on a side note, word has it that Twitter is now taking a hard look at the Elon Musk proposal. Now that he brought $46.5 billion to the table, the stock did close up 4% on Friday to end the day at $48.93, still below the $54.20 bid, suggesting that investors were not completely convinced on Friday. But today's a new day, and the stock is quoted up about 60 cents at $49.5, $49.60, while Twitter management is now forced to consider that bid, right? So Twitter could be a private company by Friday. We'll see. The S&P closed the day at 42.71, down 122 points, sending it careening through the support trend line at 44.06. This now puts the January low of 42.20 in the line of sight, and the weakness in the S&P at 5 o'clock this morning is suggesting that we could open right there, which then puts the February low of 41.30 in the line of sight. So you have to pay very close attention over these next couple of days. Earnings are only halfway over, and this week we're going to get reports from a stack of companies, including Apple, Amazon, Coca-Cola, UPS, Pepsi, Triple M, Archer Daniels Midland, Microsoft, Juniper Networks, and Facebook, to name just a few. But there's 152 more names, so get ready. Now, you'll know that something has changed when the Fed has changed their position if we hear from Goldman or BlackRock coming out suggesting that calls for more aggressive rate hikes are overblown, or if Lael Brainerd suddenly changes outfits and becomes a dove again. That'll be the signal that something has changed. Bitcoin this morning is trading down 3% at 38,300, while Ethereum is trading at 2,800. So they are struggling as well. And if Bitcoin breaks here at 38,000, watch out. Okay, so what do we have for dinner tonight? We're going to have this pulled pork, right? Makes some sense, right? Pulled pork. Anyway, thanks to my very good friend Frankie D for giving me this great recipe. And if you like pulled pork, this is a perfect recipe. You need a slow cooker for this though, right? You need a 3 to 5 pound pork butt or shoulder. You need 1 cup of ketchup, a half a cup of beer, a half a cup of light brown sugar, a half a cup of chopped onions, a quarter cup of red wine vinegar, a quarter cup of Worcestershire sauce, 1 tablespoon of Montreal steak seasoning or something like that, 1 teaspoon of garlic powder, and 1 teaspoon of Cajun seasoning. Now, you want to place the pork butt in the slow cooker. Take all the other ingredients and mix them together, stirring them really well with a spoon to get them all mixed up, and then pour that into the slow cooker over the pork butt. You want to cover it, seal it, cook it for 8 hours. After 8 hours, you're going to take the pork butt out. You're going to shred it with a fork. You have all that sauce in there that you're going to ladle on top of the pork. You can make a sandwich out of it. You can just eat it however you want. If you want the sauce to be a little bit thicker than what it is, you can always take and add in a little bit of flour, stir it up, let it sit there for a minute because the flour will thicken up the sauce. In any event, it's a great dish. And if you like pulled pork, it's a really good dish. At the moment, the markets are just about to open. They are under pressure. Global markets continue to be under pressure. The sun is coming out in Florida. It's going to be a beautiful day. Until tomorrow, take good care.